Welcome to Cross-Border Tax Talks, where we discuss the latest trends in international taxation, from Pillar 2 to Brazil's latest developments. I'm Doug McConey, PwC's International Tax Services Global Leader. The Pillar 2 engine from PwC is a game changer for Pillar 2 modeling, provision, and compliance calculations. Built on a graph system utilizing over 20 years of international tax technology, this centralized rules engine is built by a team of Pillar 2 tax experts from around the globe. PwC's Pillar 2 engine is currently available as a service and will be licensable in July 2024. On this week's episode of Cross-Border Tax Talks, we're in Sao Paulo, Brazil, for our first Latin American recording of the Cross-Border Tax Talks podcast. I'm excited to finally have my friend and fellow tax partner, Dr. Romero Tavares, on the podcast. Romero is PwC's Brazilian International Tax Leader and Professor of International Tax Law in Sao Paulo and Europe. Romero, welcome to the podcast.
Delighted to be here, Doug.
So it's so great to have you on. We have worked almost our entire careers together. You've been at a couple of different other places before we got you back to PwC, but I'm really excited to have you on. But before we get into the Brazilian tax developments, and wow, there's a lot for us to cover. In 2014, Romero, I remember you calling me. You're an international tax partner with a Big Four firm in Brazil, and you decide to quit the firm, move to Vienna, Austria to get your PhD focusing on international tax policy.
So I did.
And I was like, what? Tell us a little bit about what drove that decision and what was that experience like?
It was awesome. Basically, there were three things there going on at the same time. First of all, the world. The world of international tax was absolutely boiling. It has been since then. But I could see that something relevant would happen and that Europe was front and center. And Vienna was pretty much involved in a lot of what was going on. A good friend, Jeffrey Owens, was there in the Tax Policy Center in Vienna. And that was very appealing to me. But secondly, of course, on a personal side, I felt that there was a contribution to be made. We do tax, day in, day out for large multinational companies, and a lot of the policy discussions that were going on, I felt, were out of touch with reality. So I felt that through academia, I could actually make a contribution of trying to bring things back down to earth. And this is what I've tried to do with my work there. Plus, of course, the family experience. I lived 6 years in the US, and I wanted to have my round in Europe as well. So 4 years there was very good for my family and I.
Very cool. And the timing with respect to everything that was going on with the OECD back in 2014, that was 10 years ago. And think about how far we've come. We're going to talk, of course, about Pillar 2. We're going to talk about Pillar 1 here when we get to the end. A lot to cover from a Brazilian perspective. But I know since you've come back, one of the things that you've been very focused on is working with Brazilian multinationals and policymakers, and the contributions that you've made to the changes here in Brazil are something to be commended, and really exciting stuff.
Honored to be part of it.
All right. So maybe before we get into some of the changes and some of the recent developments, let's start with just a framework of the Brazilian international tax corporate regime. Remind folks the rate, and we've got a CFC regime, and we're going to talk about some of the big developments with TP and indirect taxes, but maybe just kind of give us an overview of what does the Brazilian corporate international tax system look like.
Might be an understatement, but Brazil has always done things its own way, right? And
you said it.
And in corporate taxes, it's no different. So we do have a corporate tax rate, which is amongst the highest in the world. Nominal rate is 34% for most businesses, could be higher for financial services industries. But even the effective rates, with all the different kinds of incentives we have, don't tend to be that much lower. Of course, there's exceptions to every rule, but it's a very particular system. So we've had particularly insulated rules. Our transfer pricing rules, as you know, were formulary, were archaic, were different. We have a withholding tax for everything that crosses borders pretty much, so that's not the standard worldwide. Our treaties are different. So basically we do have a system where pretty much every remittance is taxed at 15 or 25%. Very, very rare exceptions under just a handful of treaties. We don't have that many treaties. An average OECD country has 80, 90, the US has 70, we have like 30. And it's not enough. And the treaties that we do have are often not really respected by the Brazilian tax authority without mutual agreement procedures in place, etc. So very insulated, very aggressive in a way, very litigation oriented. But the point is, it's a high tax country, with, of course, with subsidies, with regional incentives, and with exceptions. And again, that's part of the reason why this moment that we're in right now is so relevant, because we do see some of it happening already, but we do have high hopes of Brazil converging a bit more to, let's say, the average OECD country. Not the easy one, not the hardest one, but perhaps the average profile of an European large economy. That's what we're hoping Brazil will someday get to.
I remember those OECD charts where with the US rate, when that was at 35 and it was always Brazil, we were always the outliers.
Absolutely.
And then obviously in the US with the Tax Cuts and Jobs Act came down to 21%.
Now it's us.
The cost of that was broadening the base. And so we're going to get there because
Absolutely.
I'm guessing, policymakers have to make decisions. If the rate's going down, the base needs to broaden if they want to obviously keep revenue. What about the CFC regime? So for Brazilian multinationals or other investments where there are subsidiaries underneath Brazil, what does that CFC regime look like? And then we'll talk about Pillar 2.
Super aggressive because it's not even a CFC regime. It doesn't only cover controlled foreign companies. It actually covers minority-owned companies as well. Percentage ownerships are picked up to the extent that they're within a corporate accounting consolidated group. So it's very aggressive, very broad. And again, you combine that with a full inclusion rule. So it's not just passive income. It's not even, let's say, a broad definition of passive income. The US definitions of passive income are more sophisticated, right, than most countries around the world. Brazil doesn't care. It was basically a rate differential. So we're picking up every year, every bit of corporate income from anywhere within the corporate group worldwide and taxing it at the final Brazil rate of 34%. We call that capital export neutrality, but it is to an extreme. Of course, it's so aggressive, given that it also includes active income as a predecessor, perhaps the grandfather of guilty, that tax treaties will not allow it to a great extent. So there's a lot of litigation within Brazilian multinational, that Brazilian multinational companies have to go through taxpayers in that respect, that to the extent that Brazil is overreaching business profits from other jurisdictions that are not passive at all, and that might be within the same country where that profit was generated, that's against the tax treaties that even we have in place. So big issue of controversy because it's overly ambitious, overly aggressive as a rule. And it's one of the big hopes we have that perhaps with everything that's going on that we're going to discuss with Pillar 2, perhaps that's a good way out.
Yeah, well, and if this Brazilian full inclusion regime for foreign subsidiaries is the grandfather of guilty, that means that you are the great
grandfather of Pillar 2.
You're the great grandfather of Pillar 2.
Income inclusion rule, definitely.
I will also remind listeners, because I did not mention this in the intro, that you have a law degree from the U.S. and a lot of experience and knowledge about the U.S. tax system. And so it's interesting to hear you compare, and I think we'll see that as we go through some of these specific changes, some of the big differences, particularly between the U.S. guilty regime, our CFC regime. You already referenced kind of the subpart F, which obviously predated guilty, and the Brazil regime is certainly a lot different.
Yeah.
All right. So let's move into some of the latest developments, and I want to start with what's actually been enacted. So we're going to start with transfer pricing, talk a little bit about indirect taxes, and I also know there are some other changes on the horizon from a corporate tax perspective.
Sure.
But let's start with TP, and I really want to spend some time here because this is really important for taxpayers around the globe. Maybe give us a little context, and you had mentioned briefly about the historic TP regime, but maybe give us a little context of how has Brazil historically treated transfer pricing, and then what do these new changes mean?
You can think of Brazil as strange as this may sound, but you can think of Brazil as an early adopter of transfer pricing rules. Because the rules we have, they date back to 1996. So right around the time when the first, let's say the first version of the OECD guidelines were being put out, Brazil was looking at it and say, well, it's too complicated. I want to do that, but I'm going to do that in a simpler way. So Brazil, in trying to have proxies to the arm's length standard, it came up with a set of formulas with no best method rule, where you could fit into one of those formulas that would be a presumption of compliance with the arm's length standard, basically. We had a cup, and other than a cup, we had a bunch of formulas. Of course, the system is interesting, academically speaking, but it doesn't work because it's different from every other country around the world. So of course, there's always a risk of double taxation in every situation, or even non-taxation. So given that, we actually had to live with that system for 20 years. And that was a big hazard for Brazil to actually be part of global value chains and do some of the manufacturing that Mexico, for instance, has done within the region. And that has been an issue that Brazilian taxpayers have been bringing up with the authorities since forever. At one point, after the BEPS project, the BEPS 1.0 project was finishing up, at one point there was this expectation that Brazil could accede to the OECD, and that the rules that the OECD were approving were being more protective of fiscs or treasuries around the world, and therefore Brazil would feel safe enough to align. And there was a mandate in 2017. So Brazil actually requested accession to the OECD in 2017. And the first call back that Brazil got after it requested accession was, fine, but let's talk about transfer pricing.
Wow.
So it basically went from 2018 until 2020 with a joint effort between the Brazilian tax authorities, the OECD Secretariat, and tax authorities from Spain, the US, Canada, Mexico, France, but most importantly the UK, and with funding provided by the UK, by the way, the FCO, to basically develop a path for convergence. So how could Brazil change what it was doing? How could Brazil approximate, if not align? And the conclusion of the joint project, which I was very fortunate to be a part of and actively contribute, was that Brazil was actually losing revenue on the one hand in a number of situations where the formulas didn't guarantee a proper tax base. And Brazil was double taxing the hell out of inbound multinationals doing business here, which of course dampens FDI coming into the country. So because of that, the evidence was clear and the motivation was there also from a treasury point of view for the rules to align, not just converge or approximate, but align. So we went 180. From being completely different to trying to be as aligned and as perfect, as consistent with the latest version of the guidelines as we possibly can, which is what we did.
And what are the examples of that? Maybe just a little bit practical was royalties. And I think this is a big challenge for inbound companies that invested into Brazil, made technology available. Talk a little bit about that issue specifically, particularly for inbounds as Brazilian companies are trying to pay royalties to
we had a very cumbersome system with preset formulas as per a law from the 1950s, basically setting royalties as a percentage of revenue from 1 to 5%, 1% for trademarks, 5% for industry X, Y, Z. So it was very cumbersome again, and not including a lot of the digital type intangibles, which became the most valuable or some of the most valuable that we have in the global economy right now. So the rules were not complete enough on the one hand, and where they did touch, they were formulary and they were inadequate and they were not arm's length. So effectively you had a barrier not only to the deductibility of those royalties, but for the longest time, if you didn't get the royalties priced appropriately, you couldn't get the license registered with the local patent office, you couldn't get the payments out for years and years and years. So we basically, again, had a barrier on actually making payments on royalties, and we had a barrier on royalties because of the deductibility as well. We eased the payment barrier a few years back, but we still had the deductibility issue. So now it's arm's length. So basically we're following chapter 4 of the guidelines, and basically it's a reproduction of what's there with DEMPI and with everything even that the US doesn't have. But let's say the most sophisticated or complicated way of looking at intangibles is what we have in our local system now.
So let's unpack that a little bit.
Sure.
Talk about what are some of those specific changes, and I'm also interested to understand how taxpayers are starting to react to this. When do these rules come in? They're live.
They're already on. Basically, we had a law that was approved in Congress last year, but it already was in force as a provisional measure even earlier. So 2023 was a year of early adoption or optional adoption by taxpayers. Those wanting to adopt the new law, they were allowed to, even though we didn't have the regs enacted yet. But again, depending on the profile of companies, if you had a profile that was simple enough, routine enough, why not? And a lot of taxpayers did that. Now, to the extent that you have more complicated situations or fact patterns or functional profiles, and we do have a ton of those given how the economy here is. It's large, it's closed, it's regulated, so multinational companies with footprint in Brazil, they tend to have very complex functional profiles here. For those, we needed the regs. And then the regs came out for the general provisions of the law, which again don't touch on intangibles, don't touch on business restructurings, don't touch on financial transactions, etc. But they do touch on the best method rule or the most adequate method, delineation of transactions, the different methods, and the comparability analysis, again, in a format, in a language that is absolutely consistent with the 2021-22 edition of the guidelines that's out. So basically what taxpayers have now is a law which is pretty lengthy. It's over 40 articles and with a lot of sub-items.
I can relate.
Yep.
As a U.S. practitioner.
But with 482 versus Article 482 of
Fair
the code.
enough. Fair enough.
1 to 40
Touché.
some. Yeah. And again, but then there's no comparison to the US system. It's not books of regs, right? So we have actually one reg that came out, which is decently detailed enough on the general provisions of the law, which are, again, the initial chapters of the guidelines, right? So application of the arm's length standard. We actually have codified the arm's length standard along the lines of 482. It's one of the fundamental articles of the law. Interestingly enough, the law specifically only refers to corporate taxes. So we don't use transfer pricing to adjust the base for withholding tax, which is quirky, to say the least. But you know, there's leakage, there's connections with dutiable base or with other levies, depending on how you settle or adjust transactions, which is not an easy answer in terms of how the law limits itself to corporate tax. But still, if we think about how the system works, we do have a set of regulations consistent with the guidelines, pretty much replicating what the guidelines state and adapting that to Brazil, but at the same time, it's cherry picking from different practices of OECD member countries to see what might be most protective of the treasury. So for instance, we have DEMPI, we do have DEMPI, but we have DEMPI with a definition of what DEMPI might be that you don't find in other countries, not even in the guidelines. So it's an interpretation of DEMPI, which let's see where it goes in reality. We do have a benefit test in our services rules. So in the delineation of transactions involving services, we have to apply a benefit test. That's not quite what you see in every OECD member country. So basically, and we have a country risk adjustment referred to or cited in the law as one of the potential adjustments that you might want to make or need to make. And Brazil does have the largest sovereign risk spread in the world. So if we end up transposing that to every potential transaction, we have bigger transfer pricing adjustments in Brazil than elsewhere, which is not arm's length. So there's a lot of issues there that we have to see how they play out. But the point is that the cornerstone of the law is the codification of the arm's length standard, much like 482. So if everything conforms and comports within that law, it should be, again, a sophisticated application of the guidelines rather than a deviation. We are very curious to see, and we're actively engaged also through the American Chamber and other associations, how the specific regulations on intangibles, on business restructurings, on financial transactions, etc., how those come out. Again, there's some issues there that we see even amongst OECD member countries that typically are only solved via MAP or APA, and we don't have enough treaties, so Brazil will try to regulate itself out of that hole, and let's see how good of a job it does in doing that. But again, very exciting and very much in line with the types of problems that we see in the developed world, rather than Brazil-specific problems.
Yeah, I think this is a welcome development for most taxpayers. Any thoughts on timing on those additional regulations that we may get?
Yeah, we're expecting to see those additional regulations being edited this year.
Okay.
Again, because this is the first year when it was mandatory, right? So we had 2023 as an early adoption year, 2024 as the first year where the new rules are mandatory for every taxpayer in scope, or for every transaction in scope. And the expectation was that we would have all of the regs already published before 2024. So we would start the year knowing exactly what we need to do. Of course, that didn't happen. There's some leg room in terms of when the studies are supposed to be filed, these contemporaneous studies, digitally filed with the tax return. But the 2024 tax return is not filed until 2025. So we do have time, theoretically, to prepare, but of course, there's a lot of expectation that we'll see those rules coming out by the middle of the year. So by June, July of 2024, we should have a full set of regs, so companies can actually prepare and adjust and actually adapt to what those rules might be, not at year end.
Okay. Yeah. It's always appreciated for taxpayers to get those regulations earlier in the year,
Absolutely.
not at the end of the year. And that has been a challenge, I know, in the U.S. And we recently got some administrative guidance from the OECD on Pillar 2 as well. So that mid-year guidance, I think, is always appreciated by both practitioners and taxpayers.
That's the goal now. That's the goal now. Let's see if we can make that.
All right. So let's move now to indirect taxes. And we could spend a lot of time on this. And it is an alphabet soup of various indirect taxes, and the COFINS, the ICMS, the ISS. I think all three of those are being eliminated. Without necessarily getting into too deep in the weeds, can you give us an overview? Because I want to make sure that we have time for corporate tax.
We absolutely had a hellish system, right? It was a nightmare because we had, again, all different types of levies, transactional type levies, some quasi-VAT, most of them excise type taxes, but federal, state, and local. Again, a very old system, but when it was originally designed, it was designed already assuming, knowing that Brazil is a federative state. So we had to have revenue sources for the union as well as for the states. And at that moment in time, when this system was designed, which was the 60s, VAT was the new thing, where the new kid around the block in France. So basically, we try to adapt and use the concept of input tax credits, output tax debits, but we created that in a world where the situations where credits could be accounted for were highly regulated and limited, where credits were not fully refundable. You actually had to go through a process of cross-crediting. So the system became a nightmare over time.
Globalization was just in its very early stages in the 60s.
Absolutely. I mean, we've always been a closed economy. We were even more closed then. But the point is that very, very high, when you combine all of the different taxes that we've had and applying tax on tax with a cascading effect and calculated in a way that was extremely convoluted and with a lot of breakages in the chain. So you ended up having taxes being buried into cost of goods sold and not ever visible for consumers or electors. So it was it still is very much a consumption tax-based system, where by far around the world, this is the highest jurisdiction for consumption-based taxes. It's the highest amount of revenue that the government gets, but it's really, there's no comparison. We can get to 40 or 50% of consumption prices being taxes in Brazil very easily across industries. And you go around the world, maybe 20, 25-ish might be a high tax VAT excise country. So we're pretty much double that. But again, and this was creeping up. It didn't start like that, but it started to creep up over the years. So a ton of different levies, federal, state, and local. And there has always been, for the last 30, I've been in this business for over 30 years. I've been an academic for over 30 years and also a tax practitioner for over 30 years. And over these 30 years, there's been talk about Brazilian tax reform for adoption of a single VAT system. It's the same story. And it was, at some point unattainable because politically you could never align the union and the states and the cities with their own sources of revenue to unify these sources of revenues and come up with a system that would work for taxpayers and for the taxing authorities. The beauty of what was thought and is being implemented right now is that they figured out a way to make a long transition rule taking place, where for taxpayers it's a transition over 6 or 7 years. So we have the old nightmare system still in place until 2032, but phasing out as a new system phases in, and the new system supposedly was to have only 2 VAT levies, one at the federal level, another at the state level, unified, same tax base, and the difference being an allocation of rates, and with a single rate for goods and services in every jurisdiction. So huge simplification from that angle, still very complicated because it's 2 levels of VAT. But the point is there's also an excise tax, which right now is an open-ended creation. We don't know exactly the extent of it. It's supposed to be on goods with so-called negative externalities, so hazardous to health, hazardous to the environment. But let's see how far that goes into the food industry and the beverages industries and all different kinds of industries. But the point is that the excise tax is still an animal. We don't know exactly how it's going to play out. And during tax reform, there has been an addition of some certain extractive type levies that were not even on the radar of tax reform. So there's new levies coming up for the extractive and the primary, let's say, sector type businesses, along with an excise tax and with 2 levels of a VAT tax. The design of the VAT is wonderful. It's actually an average VAT. That's why I say it's wonderful. It's not a perfect VAT. It's not the best VAT in the world, but it's an average European VAT that we're going to have at the federal and state level from 2032 onwards. The nightmare will be, again, the old system transitioning you know, out while the new system transitions in. So we have 2 parallel tax systems going on for 6 or 7 years.
And those have been enacted, and obviously there's more details and regulations.
It was a constitutional reform because our constitution is probably the longest in the world. I mean, maybe India's is even bigger, but we actually had the whole system, the whole tax system spelled out in the Constitution. So to change the mess we had to change the Constitution, which a qualified majority in Congress, etc. So it was difficult. So that actually was done. It was approved last year, historical. It's a big deal. Now the constitutional law itself requires regulations to be proposed to the Congress this year. So now the process is there's so-called laws complementary to the Constitution that are being drafted so that the system actually gets designed in detail. And it's, of course, the devil often is in the detail.
Of course.
So we have to see how exactly that plays out. But the expectation is that the system will pretty much preserve itself. There's a lot of exceptions to the general VAT rate. There's a lot of nuances to it. But it's the average European VAT system. Imperfect, but let's say understandable, rather than what we had before.
You said it. All right. So let's now move to the corporate tax system.
Right.
So I don't think we have any enacted law at this point, but what's potentially on the horizon as we think of the corporate tax system?
Yeah, we had, over the last couple of years, we've had different proposals starting to move through Congress for a wider corporate tax reform. And the main item of that reform was actually the creation of a dividend withholding tax, or the reintroduction of a dividend withholding tax in the Brazilian system. We have a rate of 34%, which was a replacement of an older, different rate that was combined with withholding tax. So we had a system that supposedly was concentrating collection on business profits at the corporate level. And now we've been discussing or debating a system that moves back to this double taxation classic scenario where business profits are taxed partly at the corporate level and partly at the shareholder level. So this was the most critical component of the proposed reform in the prior government, which would involve, of course, rebalancing the rates. So the 34% rate would theoretically go down. The taxpayers associations and academia and industry as a whole has been discussing that it would be advantageous for Brazil if it was in line with the average OECD rate. Even prior to the US reducing its corporate tax, that was a big item there on the agenda, now even more so. But basically Brazil would theoretically do well if it were to align with the average corporate tax rate of the OECD, even if it does reintroduce a dividend withholding tax, which has been debated as something in the range of 15 to 20%, still lower than the 30% FIDAP rule. In our tax treaties, we typically have either 15 or 10. So if we end up with 20 under the tax treaties, it's not all bad. If we end up with 15, most of the treaties will not help much. But the point is that the combination of both hypothetically should not be higher than 34 unless we're just having a tax hike. And that was a debate in the prior government. Of course, if that happens, given that timing is important for everybody, including for the fiscal budget, there's an expectation of a broadening of the base. So we've been having discussions about, okay, will we still have interest on net equity going forward? There has been proposals to actually shut it down. And the debate has been, should we shut it down or turn it into an allowance for corporate equity, for example? So there's a lot on the table, a lot being discussed, nothing concrete that we can point to. But the trend, as we've seen inflation in the last few years, and we've seen the transition from the prior government to this government, and with the budget pressure that this government is having to face, is a potential tax hike. So the combination of a new dividend withholding tax with whatever will happen with the corporate tax rate, and with the broadening of the base, most likely will result this year in a combined, on fully distributed profits, a combined tax hike, probably from 34 to close to 40%. So this is what we're paying very close attention to, trying to help, let's say, contain the damage. But the point is, this is what's going to be on the docket this year in Congress. I think there'll be a large proposal or several smaller targeted proposals that, when added up, they will probably mean this: the introduction of a dividend withholding tax with possibly a reduction of the corporate rate, but maybe not even that, depending on what they can do with the corporate tax base. If they broaden the corporate tax base enough, they may reduce the corporate tax rate. If not, if the corporate tax base remains as it is, then it's just a withholding tax kicking in on top of the current 34% rate that we have.
Yeah, they got to manage the revenue, and there's a lot of different levers to pull.
Absolutely.
What about Romero, how CFCs, or to your point, as you corrected me earlier, it's not really a CFC regime, it's a full inclusion regime. Right. And this really, I think, relates to Pillar 2, absolutely, right? How are the Brazilian policymakers thinking about how they may change that regime for foreign subsidiaries of Brazil? And of course, my favorite topic, Pillar 2, right. Is that something that's potentially on the menu?
It's absolutely on the radar, Doug. And this is a big expectation we have, because it's the perfect out for Brazil from its current full inclusion system. The reason for the current full inclusion system that policymakers in Brazil and the tax administration have used was that the examples of CFC regimes around the world were seen as having too much loopholes, not being effective enough, allowing for excessive deferral. Mm-hmm. And maybe they were referring to the U.S. system, maybe not. But the point is that
pre-guilty,
definitely. But the point is that after guilty, even looking at the U.S. system post-guilty, we've been saying, look, you don't have to tax everything up at 34%. Every item of active income at 34%. Focus on passive income, much like Subpart F does. Knock yourself out with definitions of passive income that make sense. And by the way,
mobile income.
Exactly. By the way, and again, for instance, foreign-based sales income is something the U.S. has had since forever,
62.
and that in Europe we don't see that often. It's typically more shareholder type, interest, dividend, royalties, etc. So look at the U.S. example. Look at the best CFC rules around the world. They'll have a more specific scope. They'll have a better defined scope within passive income. And don't overtax, don't overreach into active income as if every item of active income at a lower rate was an indication of abuse, right? So we've been saying that through different, academic institutions, associations, etc. But then when Pillar 2 comes, and it's not us saying, it's the world agreeing on here's how you can tap into residual profits or active income, which might be considered low tax. And here's, by the way, a definition of what low tax means. It's the perfect way out for Brazil from its current full inclusion rule. So the tax authorities, they have mentioned, and different people within the government, within the administration, they have acknowledged that transitioning out of the current full inclusion rule into a CFC regime with a robust Pillar 2 set of rules is something Brazil is very much interested in doing. So we do believe that that's also in the docket, but given how many things are in line, right? So they have to finish up regulating VAT reform.
Plate. Yeah.
They have to do internal corporate tax reform, and they have to do the international tax reform. So, but all of that is in their plans. It's in the agenda. It's mapped. It's on the radar. So, which is good. So we do have an expectation that perhaps later this year, after the team that's regulating transfer pricing, which is the international team, and a lot of the people are the same, that will be looking at CFC rules. So once the team finishes regulating transfer pricing, it's likely that they'll move into figuring out how Brazil will fit Pillars 1 and 2 actually into the local system. And in figuring out how Pillar 2 fits, they will see that there's a connection, there's a clear connection of the income inclusion rule with our full inclusion rule, and perhaps harmonizing the two would be good for both, good for Treasury as well as good for taxpayers and for the economy as a whole. So we do expect to see that perhaps later this year, perhaps next year.
But the government hasn't given any firm
no
message.
Draft, no. I mean,
or when it may be effective or anything.
Not at all, Doug.
Okay.
Basically, we have had, again, in different public settings, we've had messaging, we had not commitments, but messaging and narrative and verbal indications that this is next in line, right? So perhaps the line will move fast enough and we'll see something coming up in terms of draft legislation this year, but it doesn't seem like there'll be room for it to not be done next year.
Okay.
So that's my view here. Either this year or next year, we should be seeing either as part of the wider corporate tax reform, or most likely as a second step. So we have the larger domestic tax reform going through and the larger definitions of base and rate going through. And once they know what the rate is, then they'll see what they can do with the full inclusion rule versus Pillar 2.
What about Pillar 1? You had mentioned that. That appears to have lost a little bit of momentum globally.
For sure.
But what are you hearing from a Pillar 1 perspective for Brazil?
Huge expectations in Brazil. And again, this is because Brazil has been an outlier since forever, and it will very much continue to be in a lot of issues. But the point is that we already overtax every remittance, as I've said here in the beginning. So we have more than amount A going on, or DSTs, etc. We've had that since forever. Between withholding taxes and equalization type levies, we've had all that game. And it's not by chance that the Department of Commerce has included Brazil alongside the digital services taxes jurisdictions when it was doing its whole inquiry, right? Because of the old taxes that we have. So on the one hand, there's this expectation from business that perhaps if there's a decent Pillar 1 solution, that solution would be better, would be less onerous for business than what Brazil currently has. That's one way to look at it. But most importantly and less ambitiously, not thinking about amount A, but thinking about amount B, what Brazil has always tried to do was to provide more certainty also with respect to transfer pricing. So there's been this huge discussion of how Brazil will do safe harbors under the new rules. And a lot of the discussion on safe harbors under the new rules, inevitably they end up touching on amount B.
Sure.
And will we do exactly as the rules or the model, the approach for amount B is being designed, and incorporate that into our soon to be published safe harbors, or will we go beyond? Will it be safer, or will be less safe? But the point is that there's a lot of interest and there's a lot of involvement of the Brazilian authorities that are regulating transfer pricing with the working groups at the OECD that are working on both pillars, but most specifically on amount B. So I do expect to see whatever comes out, even if it's not consensus. And we've had just now on the 19th of February, we actually had new guidance coming out of the OECD in terms of how the matrix for amount B might work and how country risk is included in the base routine type activities. That's very interesting, could be very useful for Brazil because we do have the country risk notion and we are looking for safe harbor rules. So that's something that I do believe we may end up incorporating.
Yeah, it's interesting, and we see this in the US a lot, that proposals, as they get proposed, even if they don't get widely enacted or specifically enacted, it creates something that policymakers can pull off the shelf, so to speak. And so, to your point, even if amount B does not get broad adoption through across the various OECD or across the globe, still certainly something that Brazil or other jurisdictions can potentially use.
Absolutely.
So I want to move to the last topic here because holy cow, Romero, just a lot from a policy perspective and actual change that's taking place. But want to move to really what taxpayers are doing for Pillar 2, because it's 2024.
Right.
We now have 37 countries that are enacting or have said that they are going to be enacting Pillar 2 within their specific jurisdictions. And obviously a big market here, lots of Brazilian multinationals with greater than 750 million euro top line revenue that operate in jurisdictions, a number of European holding companies, another number of European jurisdictions that are common holding companies for Brazilian multinationals. So they're in the soup, so to speak, for Pillar 2 and need to start thinking about income inclusion rules. Maybe just a few minutes here. What are you seeing from a Brazilian taxpayer kind of outbound perspective for Pillar 2? It's still early here. We're recording this at the end of February in 2024, but any trends that you're seeing, and even across Latin America as taxpayers start to realize all of the data and work that needs to be done to actually start to comply and think about providing for Pillar 2 taxes?
Yeah, I can actually see two different types of movements going on with taxpayers in this market here. I do see, and I have to mention this, even with respect to the non-Brazilian multinationals that do business here, a lot of surprising calculations coming up. as people end up figuring out that the globe income and the cover taxes equations under Pillar 2 in our engine shows that pretty well, they will probably come up with a rate that's unexpected and sometimes lower than they might think.
Right.
So
Similar
in the
to the
case
US.
of Brazil, exactly.
Yeah.
So in the case of Brazil, given the different subsidies we have, regional, federal, state, local, sometimes you have a potential hypothetical exposure of Brazilian
Don't
income.
take for granted
to the
that
globe rules.
all those taxes that you mentioned are actually good covered taxes and subsidies.
Exactly.
That's a
So
great
that's one movement that, again, because there's more awareness, I would say, and that's already a spoiler of my point on Brazilian multinationals, but because there's more awareness around the world with US headquartered, Asian headquartered, EU and headquartered companies about what the rules are and how they play out, we've seen some movement with Brazilian inbounds already figuring out that either they might have an exposure here if they don't have a carve out, and that's happening already.
Great point.
Parallel to that, we do see with Brazilian multinationals, firstly, the concern that was being raised was exactly because of the holding company structures. So will the holding companies, the IPEs, right? So the intermediary parent entities within the group, will they be enacting a rule that will pick up the potentially, let's say, lower than 15% income from around the world? So that type of awareness was happening. So work has started for the global calculations to be done, but focusing first, and that's where I see that there's a lot more to be done here, but focusing more on whether the EU companies will actually be the ones having that leakage. But it's, as we all know, it's much broader than that. And that awareness is building up. It's almost quasi-educational, right? So awareness is actually growing here, that the exercise is a lot more complicated and that it has to be done centrally. Because again, it's Brazilian accounting standards for an ultimately Brazilian parented company that have to be applied worldwide. So the exercise will never be full or complete unless it's properly done centrally. We haven't seen a lot done here, definitely a lot less than what we would believe would be recommendable. But as you said, it's still early enough. I think we're still being in early 2024. We still have a few months this year for Brazilian multinational companies to realize that they have to centralize the exercise, do it here, and really do the math, which is not easy, it's not trivial, to figure out where the exposure might be on the one hand, and on the other hand, given the turmoil in policy and the fact that through an income inclusion rule, perhaps some of those gaps may be filled with more containment versus a UTPR around the world, that some engagement in policy is also due.
All right. Well, Romero, amazing. We covered a lot of ground here. Lots of changes. Want to commend you again for all the work that you've done. We've been talking about doing this for a very long time. It's great to be down here in Sao Paulo with you. You've been a fantastic host, and thanks for coming on the Cross Border Tax Talks podcast.
Pleasure to be here.
So thanks for tuning in to this week's episode of Cross Border Tax Talks. Thank you, Romero Tavares, PwC's Brazil International Tax Services Leader. I'm Doug McConey, PwC's International Tax Services Global Leader. Stay tuned for another exciting edition of the Cross Border Tax Talks podcast.
This podcast is brought to you by PwC, all rights reserved. PwC refers to the U.S. member firm or one of its subsidiaries or affiliates and may sometimes refer to the PwC network. Each member firm is a separate legal entity. Please see www.pwc.com/structure for further details. This podcast is for general information purposes only and should not be used as a substitute for consultation with professional advisors.